Welcome to StokTok's deep dive into KKR Co Inc. KKR is one of the world's largest alternative asset managers, deploying capital into private equity, private credit, and infrastructure investments on behalf of institutional and individual investors worldwide. As of May 1st, the stock is trading at $103.68. Over the past 52 weeks, the stock has ranged from $82.67 on the low end to $153.87 on the high end. The stock is currently below its 200-day moving average of $120.38, though it sits above the 50-day moving average of $94.45. The Relative Strength Index, a momentum indicator, stands at 59.3, suggesting neutral positioning. Let's work through the fundamentals, scene by scene, starting with a quick business overview. KKR operates as a global alternative asset manager, generating revenue primarily through management fees on assets under management, plus performance fees, or carried interest when its portfolio companies and funds generate returns above agreed benchmarks. The firm's competitive moat rests on its track record of generating superior risk-adjusted returns, its deep operating expertise, and the scale of its capital base, which creates barriers to entry for smaller competitors. The StokTok score on this name is 64 out of 100, marked as a hold. Breaking down the scorecard: Valuation scores 10 out of 20, Financial Health scores 10 out of 20, Profitability scores 4 out of 20, Growth scores 20 out of 20, and Smart Money Positioning scores 20 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? KKR is trading at a price-to-earnings ratio, based on trailing 12 months of earnings, of 44.31 times. That is substantially elevated relative to the forward price-to-earnings ratio of 16.77 times, which suggests the market is pricing in material earnings growth ahead. The price-to-sales ratio sits at 5.16 times, indicating the stock commands a premium to revenue. The enterprise value to EBITDA multiple stands at 6.71 times. The PEG ratio is 0.00, which reflects the disconnect between the current valuation multiple and forward earnings growth expectations. In our view, KKR's competitive moat in deploying capital and generating alpha, combined with the recurring nature of management fees, provides pricing power and justifies a premium valuation. However, the stock is trading at precisely its intrinsic value according to our DCF model, with 0% margin of safety, which warrants caution given execution risk. Wall Street analysts covering the name have a mean price target of $123, with a high target of $153 and a low target of $102 across 19 analysts. That upside from current levels aligns with the forward multiple compression story. Let's examine the latest results. In the second quarter of 2025, KKR reported earnings per share of $1.15, beating the consensus estimate of $1.13. Revenue came in at $5.69 billion, which fell short of the estimate of $25.65 billion. This miss appears to reflect timing of certain revenue recognition items rather than underlying business deterioration. Revenue growth on a year-over-year basis was 4%. Operating income was $360 million, and net income was $1.15 billion. The stock declined 0.1% in after-hours trading following the earnings release, suggesting the market digested the results as mixed but not disappointing. Market sentiment around KKR leans bullish, with expected growth exceeding 20% annually and institutional interest in portfolio company valuations, though the broader private market sector faces headwinds from redemption pressures and macroeconomic uncertainty. The consensus view is that valuation, while not cheap, is justified by growth prospects and management's track record, and the street anticipates the next earnings report in May of 2026 will provide clarity on earnings trajectory. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist of financial health metrics, comes in at 6.0 out of 9, indicating moderate financial quality with some areas of concern. The Altman Z score, which models bankruptcy risk, is at 0.89, placing the company in the distress zone. This warrants attention, though we note that asset managers with significant off-balance sheet assets may not map cleanly to traditional distress models. Looking at the balance sheet directly, cash to debt stands at 2.43 times, meaning the company has $2.43 of cash for every dollar of debt outstanding. That is a healthy position. However, interest coverage, the ratio of earnings to interest expense, is just 0.16 times, which is weak. This reflects the fact that the company carries substantial debt on its balance sheet and operating income has not grown proportionally. The current ratio is 4.18, indicating strong short-term liquidity and plenty of assets to cover near-term obligations. Debt to equity sits at 1.77 times, representing moderate leverage. In our view, while liquidity is strong and cash generation supports debt service, the weak interest coverage and Altman Z score suggest investors should monitor leverage ratios closely. The balance sheet is not distressed today, but elevated debt loads create constraints on management flexibility and compound downside risk in any market downturn. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 0.19%. That is extremely low and indicates the company is not deploying its capital base to generate returns much above its cost of capital. This is a red flag. Gross margin stands at 18%, reflecting the economics of the asset management business, where revenues are partially offset by direct costs of managing those assets. Operating margin is 2.55%, a thin figure that reflects the significant operating expenses required to run a global institutional asset manager. Net margin is 12.34%, which is respectable, and reflects the operating leverage that emerges after non-operating items and taxes. Free cash flow margin, which measures the percentage of revenue converted to actual cash available after capital expenditures, is 1.65%. This is low and suggests that, while the company is profitable on an accounting basis, it is not generating abundant free cash relative to its revenue. In the second quarter of 2025, net margin held at strong levels given the earnings beat, but the weak free cash flow conversion remains an ongoing concern. In our view, the profitability picture is mixed. Solid reported net margins mask weak returns on capital and thin free cash flow generation, which constrains the company's ability to fund growth, shareholder returns, and debt reduction simultaneously. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 51.10%, an exceptionally strong compounding rate that reflects both organic growth in the alternative asset management business and inorganic additions. Over the past 5 years, revenue growth is 17.20% annually, which is still solid, but marks a deceleration relative to the 3-year run rate. This deceleration warrants monitoring, as it may reflect market maturation or base effects. Book value growth over the trailing 3 years is 15.70%, indicating that the company is growing its equity capital base at a healthy clip. The dividend yield is 0.70%, a modest payout that leaves significant earnings available for reinvestment, debt reduction, or strategic acquisitions. In the second quarter of 2025, the company reported year-over-year revenue growth of 4%, which represents a material slowdown from the prior 3- and 5-year trajectories. This quarterly deceleration suggests headwinds from redemption pressures in the broader private markets industry, seasonal factors, or timing of performance fees. In our view, the growth picture is strong in the long term but shows near-term fragility, and management's ability to sustain 20% plus revenue growth going forward, which the street is pricing in, will be critical to the bull thesis. We will want to see evidence of stabilization and acceleration in the next quarterly results. Now let's talk smart money, what institutional capital is actually doing with this name. 14 of the world's top-tier institutional investors, tracked by Dataroma, currently hold KKR. Among 13 F-filers, which are large institutional money managers required to disclose holdings quarterly, 7.2% are net buyers, meaning they are accumulating the position rather than trimming it. This is modest buying interest but not overwhelming. Insider ownership stands at 10.78%, which is meaningfully elevated and indicates that management has substantial skin in the game and is incentivized to drive long-term value creation. Over the past 3 months, insiders have executed 8 buy transactions and 0 sell transactions, a pattern that suggests confidence in the business at current levels. Looking at specific holdings, Chuck Acker at Acker Capital Management has KKR at 11.33% of his portfolio, but recently reduced his stake by 6.97%, a tactical trim that suggests some caution. Stephen Mandel at Lone Pine Capital has increased his position by 22.56% to 4.68% of his portfolio, signaling conviction. Thomas Gaynor at Markle Group maintains a stable position of 1.12%. Ariel Investments has added to its position with a 3.70% increase. Bill Nigrin at Oakmark Funds has trimmed slightly by 2.56%. In our view, the mixed signals from top institutional holders, some trimming, some adding, reflect the tension between the company's strong competitive position and near-term growth challenges. The insider buying pattern is noteworthy and suggests management believes the stock offers attractive risk-reward at current valuations. And finally, the verdict. Let's bring it all together. On valuation, KKR is trading at precisely its intrinsic value with no margin of safety, and while the forward multiple is reasonable at 16.77 times, the stock offers limited downside protection if growth disappoints. On financial strength, the balance sheet is adequate but saddled with elevated debt and weak interest coverage, creating constraints on strategic flexibility. On profitability, reported net margins are respectable, but return on invested capital is negligible, indicating poor capital efficiency, which is a critical weakness for an asset manager. On growth, long-term revenue growth has been exceptional, but the most recent quarter showed material deceleration to just 4% year-over-year, raising questions about the sustainability of 20+% growth expectations embedded in current valuations. On smart money, institutional holders are divided, with some trimming and others adding, while insiders are buying steadily, suggesting belief in value at these levels. Taking the latest earnings results into account, the second quarter beat on earnings per share was offset by a revenue miss, and the weak year-over-year growth rate suggests near-term headwinds that may pressure multiples until visibility improves. The overall setup in our view is balanced risk-reward. The company has a fortress competitive position and exceptional long-term track record, but valuation leaves no room for error. Balance sheet strength is moderate at best, and near-term growth momentum is fragile. This warrants a hold posture. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on KKR Co Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.